So maybe I'm like a Fed purist, but I think they look at this and say, you know, stuff like this happens in markets, and they'll be looking much more at the economic data. I think that's a much more consistent thing for all of us to be looking at, frankly, than day-to-day volatility or month-to-month volatility. So I'm still.
Does that suggest they should take a pause?
No, I'm still in the camp that they probably have one or two more left, at least. You know, and they'll look at the data.
But only one or two in the next year would be taken as dovish for them from the market.
Yeah, well, I don't think they're in a hurry. I think they'll be judicious and cautious with it. So I do think they have some room because they're always concerned about creating an inversion, which would be really bad, I think, for the market. So there's some room here between, you know, Fed funds and sort of the 10-year and the 30-year. There's definitely some room for them to play. And I agree with Steve. Somewhere between 2.5 and 3.5 is neutral. If they got to 3, that'd be a real psychological victory for them. And there's going to be a real push for them to do that, I think, based on the economic data that we're seeing.
Yeah, Steve,
Sarah, I think it's the Fed may have done a disservice by not pointing out, and I'm not sure this is true, but I think some of what the Fed wants to do in terms of raising rates is kind of disconnected from the data. And I think this move to neutral and the other idea that the other side of that same coin is taking away the emergency rates of the financial crisis. I think they want to do that. They'll do it gradually. They don't really want to upset the market, but they still want to do it. And I think that move is sort of disconnected from the data. I think there's more they may have to do if the economy ends up still going gangbusters, still going 3%. But I think trend growth right at 2% is still enough in the minds of several Fed officials for the Fed to go to 3.
Yeah, I mean, we have to keep what's unnerving investors.
Right, exactly. And they don't like the fact that the Fed is focusing on the data, which still seem to fit with that idea that they have a few more to go. And also, we're 8 or 9 months from the whole discourse being about overheating, right? I mean, so in other words, the market in the moment doesn't always get it right in terms of how the economy is going to unfold. But Jeff, I'm wondering if it's not an economic issue, are you seeing anything through the capital markets lens at your firm where, besides stocks being down a bit, there's any disruptions or anything like that?
No, we're not. I mean, people are preparing to do what they need to do in order to execute. And I also want to be really clear about this. I think we're in a different spot than what most of us are used to in seeing markets. So I've been on this big kick where I've said, I think we need to measure time in terms of experience, not in terms of increment. So when we see moves like this, think about the amount of data that people are processing on a microsecond basis. Moves like this that now appear to happen in a day would have played out over months or quarters in prior cycles. So we see a move like this where like it's violent, but I look at this and say there's just a lot of data that are being processed and the markets have a chance to readdress or reset much more quickly. And so that also means they have the ability to rebound quickly once the data begins to read differently.
How are your clients feeling, Jeff? Do you think they've had that moment of fear has peaked or can things still get worse?
This has been very orderly, so I don't think that we've seen the fear factor. But I will tell you, if you look at hedge funds have gotten smoked in the last, 6 weeks. I think they were really offsides for the most part. A lot of them were in this market. So we at Cowen have been very cautious. I will just say we've played it very, very close to the vest. We've taken as much beta out of our exposures as we possibly can on our balance sheet, and certainly with our businesses, we're doing things to make sure that we're not so dependent on market directionality. But that's just, I think, long-term good business building. And so, we're not seeing massive panic.